Hello, everyone. Welcome back to a news episode of Decoding Market in Three Moves. I'm Shivajit, and today we are privileged to be joined by Mr. Rohit Srivastava, a renowned market strategist known for his expertise in financial trends and strategic insights. So, welcome back, sir. After quite a long break, so we are back with the decoding series. So,
We had a two week long break, one because of Goa and
right.
second because of various meetings and appointments. So I'm sure everyone's missed it, but and probably thought that we stopped doing it altogether. But we are back on online.
So I am here to just ask you questions, so I won't leave you without asking questions. So this series will go on. There is no end to the series
Right.
because as the waves we know it sometimes go ups and it sometimes dips down. So
Yes.
that is the thing with our series also. We also have ups and downs.
Yeah.
So it's a new week, starting of the week, Monday. How is the market, sir? What are your thoughts?
So it looks like that the downward trend that we were seeing is in continuation. This is the one, two, three, four, five, six, seventh consecutive down day. When this fall started, I thought it'll be a two day, 3 day affair at the most, and possibly won't go below 25,000. Now here we are at 25,634, still waiting for the bottom formation. It's still not clear that we are there yet. So I'm well. It's expiry week. You have the monthly expiry tomorrow on a Tuesday. So we
Right.
were so much used to the idea that it's always a Thursday, and now it's a Tuesday. So I think that maybe let's see whether Tuesday really helps in setting the tone in any way. But yeah, I think the market pattern will become more clear after expiration. But for the time being, the current downward trend seems to be continuing. So yeah, the week has just started like every other day last week.
So, moving to the first question for today's episode, sir. According to the article which was published on India Charts on 25th of September, what are the key technical indicators suggesting that bullish options for gold remain open despite gold being very overbought on the monthly RSI?
Well, it's a tricky situation because usually when you go this far in something, you want to be on a back foot, just in case something goes wrong. Okay, so it's very very hard to take a bullish call at this point in a move, except that the theory is, especially with precious metals, that they can sometimes extend far more in a fifth wave, because of the psychology of panic. So basically, commodities go up in fear of shortages, fear of other events, and therefore they tend to overextend on the upside, just like a bear market overextends or overshoots on the downside during panic. So you actually end up getting panic buying when it comes to precious metals. Now, I don't know if you've entered that stage, but definitely markets are giving you that kind of behavior, that kind of feeling that they don't want to stop at any level. So the only way is that you extend the move, you try to continue to ride it as far as it goes. There's no trend reversal. We are making a series of higher highs and higher lows on the daily chart. And if you just keep trailing that, so after today's move that we are seeing intraday, we'll probably leave behind a higher low at 3717, which is a huge improvement from where we were earlier at 3627. So it's slowly moving up from 3727. When you move up the level to 3717, you almost moved it up by $90 in terms of the previous low from where the trend is in continuation. So that's what is happening, and you're continuously adding. points that way every day. Like today, we're adding some $58 on gold and some 90 cents on silver. So silver's probably pretty much gone exponential. We were using a channel, it's broken out of that and started to extend, which means the fifth wave itself may be subdividing into larger 1 2 3 4 5, which is like it can just go on for weeks to come. So you just need to step aside. That is the only solution. Step aside and let it run. That is the thing to do.
Got it, sir. Mm. So it's better to just step aside.
Yeah.
So moving to the second question for today's episode, how did the latest US inflation data influence the Asian stock market performance today, especially regarding gains in major indices like HSI and Shizn?
So I don't think they are really impacted by the inflation data. China and all have been, see what has been happening for months together is they've all been doing their own stimulus, cutting interest rates, increasing spending. Is sort of what every country is doing. US was the
Hmm.
last man standing in that, and was actually not doing much because they were scared of inflation. So inflation data is playing an important role in the idea that US joins the herd in terms of cutting rates and spending more. I don't know how much more they can spend because they're hitting a debt ceiling, right now. But definitely, they can at least make the situation more manageable for themselves by cutting rates and reducing their debt burden. And on the other side, as much as we may not like it in India, they're using tariffs to raise money. So they're doing things that will help them survive. And in the meantime, others have been stimulating, and anyway, allowing things to improve. So when I look at China HS, I think it's an independent story. It has not so much to do with US interest rates. Uh, in fact, China is a market that was in doldrums for a long period of time. So it's actually coming out of that. It's just like
Hmm.
what Japan did a couple of years ago, where it came out of huge trough, almost a 20-year period of underperformance, and now it is an outperforming market. We are seeing that happen in Europe. You're beginning to see that happen in China. So many of these markets are actually holding out and doing really well. The only problem child right now, I would have said it's US, but actually US markets have also done well. The real problem child is India because we have been targeted by this tariff regime in the US.
Hmm. So it's been like everyone knows that eh, the things are going uh, on a rough note between US and China. Yeah.
No, between US and India, not China.
Oh, sorry, my mistake. I was thinking of India and it came out of China. Sorry, sir.
I mean, they're also having talks with China, but at least they haven't raised, I mean, taken things as far as they have taken it for India.
Right. So there is like, okay, आपके साथ भी करेंगे trade war, but this is the first enemy that we are gonna shoot. So in this sense, yeah. So moving to the last question for today's episode is based on the current wave counts and trend analysis mentioned in the Nifty intraday update.
Yeah.
What is the anticipated level of the Nifty if larger wave Y unfolds, and how do the equality and 1618 level affects this projection? Like how?
So, so essentially, we're trying to look at what the downward risk is. What I'll do is on this question, let me share my chart. Okay, when we're actually looking at the Nifty chart here, and we're talking of equality. So the only thing I can think of is this bigger move, which is not what I was referring to in the intraday update, though. I was referring to, uh, not really having any reference point. Okay, so we're basically not sure what the internal wave count is for this fall. So we don't have that, so we can't really project where it's headed. But yeah, for the larger structure, if I consider it as WXY, then uh, the quality level for this move would be somewhere around 24,093. Okay, so that's pretty low. It will mean breaking the 24,400 shelf support. I'm not sure we will or we won't. I think we will. I just don't know how far. Okay, so the weekly bands, for example, are at around 24,000 240 or so, and probably another level which is around 38% retracement of the entire move up that we saw from here to here is at around 24,170 odd. So I think that is an interesting range somewhere for a support. Now this equality is given us one more level, which is 24,070. So that's now if I put all of that, that's a 300-400 point range here we are keeping in mind as to where markets can fall and probably get very oversold. So we have a couple of short-term indicators that are telling us that we are oversold, but we are still not 100% there till we get a price reversal, and that price reversal is missing, and that is why we are still waiting for it to play out. Uh, we are not really preempting a reversal yet, but I think it should be round the corner.
Uh, so, can these charts be in bright color, like a white color, if it's possible?
Yeah.
We
It
are
is.
getting.
Have the I mean, I can't do it to this itself, but I can open a white chart. My
Mm.
markings will not be there on it. So what I was talking about was essentially this. Did someone make a mention about the color?
Yeah. So actually, we got a comment from one of our subscribers. So it was difficult for them to just view in the dark mode.
We can make it this way. We can even make a parallel channel if we have to. A couple of. So even if I draw a downward channel like this, we end up somewhere around 24,180. I think 24,180, 38% retracement sounds like a good level, but it's still pretty far from where we are right now because that's another 400 points down. I feel at a minimum we may just break this. That's my sense.
Right. Mm. Got a overview of that thing. So let's move towards the questions asked by our subscribers. We will pick three questions for today and only three. Moving with the first question, sir. It's from Dheeraj.
Nifty on weekly charts has broken down of upward channel like flag and pole. This is very tricky because it depends on how you drew it. So if I go to my chart and look for a flag and pole, matlab, okay, I think I know what he's talking about. What he's talking about a reverse flag.
Yeah.
Yeah. The only catch with those patterns is so you have to, it really depends on your big picture view. There are times where a pattern like this can be very, very bearish. And there are times where in which it will break the bottom end and then become a bear trap as well. So which one is going to be the case? We have to watch out. Right now, I'm trying to think it will not be a massive move, but who the heck knows? But we haven't broken the lower end. See, we can. Let me just again. I have to share my screen. Where the heck? We get lost. So this is sort of what he's referring to. What I've drawn over here is what I think he's referring to. But if this is a flag and it's breaking down, it hasn't broken the bottom end, but it has failed at the top end. So usually failure means you start anticipating that the bottom end will break. The question is not whether it will break. The question is how far can it go from there on the downside.
Move to the next question, sir. It's from Ritesh Kumar Shukla, asking about the Fed reducing rates.
Two 2007-8 like situation. I have only one thing to tell Ritesh, that people have spent the last 15 years looking for the next 2008 like situation. So while it's possible, let's not spend our life looking for the next 2007-8. 1992, Harshad Mehta did not repeat. We did get Ketan Parekh in 2000, 10 years later. Ketan Parekh has not repeated. We got GFC and the Y2K bubble. That has not repeated. Something new will definitely happen, but it won't be 2007-8. So Fed has started to cut rates. What bond yields may rise in anticipation of inflation. So you see, actually, what happened, and if I can think, if he's referring to what I think he's referring to, is the inflation we got in 2008 June July, because oil prices went to $135.
Mm.
So what you have to really note here is that Donald Trump has tried very, very hard and successfully so far to keep oil prices from going up, which is the main inflation trigger. So he's doing the exact opposite of what we are thinking. We are thinking that, oh, bond yields will go down, but inflation will go up. But that time you were in the 6th or 7th year of a commodity cycle with the dollar falling and interest rates near zero, that drove commodity prices far enough high to create that inflation. Right now, commodity prices have been falling for more than a year. They are not going up. Donald Trump is saying pump, baby pump, pumping away as much oil as possible. He wants Russia, Ukraine to get solved so that there's more oil in the market. And therefore, oil prices don't come up and inflation doesn't come up, so that he can reduce interest rates to pay his bills, which is the interest on his debt. It's not the same situation in so many ways. So interest rates are not going down because of an economic slowdown. US GDP just reported a 3.3% growth number last week, which can be inflationary, but interest rates are not going down because of a slowdown that will trigger the commodity prices. Interest rates are going down because commodity prices are already down in the dumps and not rising, and therefore inflation is not showing up. The only inflation that's going to show up is because of forced tariff rates, forced increases in prices.
Hmm.
Very important for people to just assimilate. It's a very different environment.
So moving to the last question for today's session.
Hmm.
Hmm. Similar approach.
Given the fact that we know India is targeted by US, how long can the underperformance for Indian markets? That is a good question. Uh, if you ask me, I think the period of underperformance is about to end anytime. Okay. Uh, India and US are in active talks to get this resolved. You'll surprisingly hear the positive news someday. India is cutting interest rates. I'm hoping that the RBI will cut rates further in the upcoming meeting. Usually I think they have one in early October. And inflation in India is down to 1%. I mean, it's as silly as that. If they don't cut rates, then they'll be like Jeremy Powell, who doesn't want to cut rates. But that was the situation with the last governor. This governor is much more proactive. So I expect he will cut rates. So you already have that. You have the GST trigger. You have lots of news around H1B visas and pharma. So you see, when tariffs came, the fear of people was that, oh, tariffs are on, goods and all, but what about services, and what about pharma, and what about these other sectors? And then we felt like, oh, these export savvy sectors are going to get saved. But what if they don't? Well, now the news is out. The news is that they've been saved for the time being. The H1B visa issue is there, but it's tomorrow's problem, not today's. Would I buy IT stocks? I never wanted to buy them yesterday. So anyway, it doesn't bother me. I hope they remove them from the index only to solve the problem. But it won't happen because Infosys is too big a company. But the
Yeah.
company grows earnings at 5%. And when a company grows earnings at 5%, I have no idea why I should be interested in large cap IT that is growing earnings at 5%. Some mid caps have shown higher growth rate. That's the only place where you've seen some meaningful performance. I mean, there was an interesting chart. I was sitting with a friend on the weekend and sharing it. I think I'll show it just now. It's on strike only. Let me just show this. Okay, guys, I'm using a stock example. This is not a recommendation. We are not investment advisors. But I'm just showing you an example of what you can see. You can see my screen.
Yes, sir. So,
I'm going to ratio charts. Okay, and in ratio charts, what I'm going to plot is a ratio of Infosys to Nifty. The purpose, and we can try and do Wipro also. The purpose is to really look at, see, if you want to buy the best performing stocks, what would they be? They would be stocks that have performed well relative to the index and on a long enough period of time. So I'm going to take a monthly chart. Now, this is a monthly ratio chart of Infosys to Nifty. What did it show from here, from the end of the Y2K bubble till COVID? Infosys is underperforming Nifty because this green line at the bottom is not going up. See, when it is going up, that's the only time there is some outperformance. In 2 decades, there was only outperformance for this short period of time, around a year, when the green line went above this. Now it's back below this. So that means that if you bought Infosys here over 2.5 decades, you didn't make more than Nifty. So much for what you believe is a high growth stock. It's not a high growth stock. The tech sector has gone from being growth industry to being defensive industry. People buy it because of the low earnings growth when nothing is any earnings growth. When nobody is growing, they say, chalo, yehi le lete hain because there's 5% earnings growth. But when you have companies that have 40% earnings growth today in mid caps and small caps, why would you want to own companies that have no earnings growth? So all this tariff, ESOP, IT sector, frankly, doesn't matter unless you own only IT stocks. And I have absolutely no reason to buy IT stocks. So I'm just giving my personal opinion over here. I don't own them. I'm not short of them. And I'm not an investment advisor. So I'm just sharing an opinion. And that should be clear. But this is how I think. Now that leaves us with pharma. Pharma is a nice sector. There are plays over there that happen. And the news that they announced on pharma also has a limited impact, right? Limited because it doesn't affect generics right away. It's only meant to hit companies that do not really produce anything in the US. So if you're producing some new drugs in India and trying to sell it to the US, yes, you will attract tariffs. But if you're a US company that is already producing there and you're importing from India and selling it there, then it doesn't affect you. So again, there's a positive rub off over here. Now there's one last. I mean, so this was an interesting chart. You can do it with some other Wipro's relative performance is even worse to when you compare it with the Nifty 50. If I'm not wrong, what I remember. Yeah, like I said. So from here to here. So here you're not even you're just performed like Nifty. No, here you've performed worse than Nifty for 2.5 decades. So you've already lost the case because the growth rate is much lower than the market's growth rate. So the only companies that particularly did well were individual companies like maybe a Tata Elxsi for some period of time would have outperformed. Okay. When it turned into high growth. So that happened somewhere from 2013 onwards. It came into focus here when it made these big moves. And so it actually did well, much better than the index. So they were so that's why we said the whole focus has been mid cap IT or companies that have managed to grow at a higher rate because of certain products or services that they were offering. But large cap IT that was purely in manpower services or that have not evolved, like today you're in the world of AI and you don't have any major AI product, then you've sort of lost it. I know when we talk about IT, I probably come all down on it because I've spent so on the value wave theorem of ours. The IT sector fits in what we call as the fifth wave or the last stage of the cycle. Unfortunately, I thought the fifth wave would have ended in 10 years. It's gone on for 2.5 decades. So what is a fifth wave? The definition of a fifth wave is essentially a company or a sector that is growing at a rate slower than its peak growth rate that we saw in the third wave. Either that or its margins are contracting or something fundamentally is weakening. Okay, ROEs are coming down and so on. Now, that doesn't always result in price deterioration, but it definitely, as we just saw, can result in underperformance. Okay, so that is a fifth wave. At some point of time, the only way you can get back is get another first and second wave and a third wave, which means the company has to re-engineer itself into something new, which makes it a growth stock again. There are companies that have managed to do that in the US. IBM, for once, had become like you don't know whether IBM will do anything again. And then they re-engineered from being a computer company to becoming a company in services, things like SAP and whatever. They got into all that business management services. So they had to do some kind of re-engineering, right, to come back in business. Either that or else you will terminate. So that's the risk with this sector long term.
That is the reason you always say that it's better to be like, क्या ही करना है? You can get
I mean, you
better
can find some
returns.
trades. You can find some trades over there in the short term,
Yeah,
which is more technical. But long term, I just don't understand why I will be there.
because even if I go on for a savings account, that is also giving us the same interest rate as this.
Better maybe.
So yes, maybe better in some cases. There are some banks that are giving out 7 to 7.5% returns as well. So why to go in this and just actually hammer your head?
Yeah, but there are other opportunities. So there are other stocks that are giving you a higher growth rate. You don't have to be in tech,
That
and you don't need to be in fixed deposits, but you can be in
yeah,
better equities. But yeah,
yes, sir.
the equity bond comparison makes sense for making that decision.
So I just want to highlight one question over here. Of Mandar Patil. So if you want to, like, you do you have any Q&A on the Strike platform? We will be hosting webinars about the Q&A session on end of every month. So we just hosted a Q&A session. It was the starting of the series. So you can just watch the series. It's live on YouTube as well. And you can enroll for the next series as well. We will be sharing the links shortly on our WhatsApp community as well as our Telegram channels. So the links of the channels are also mentioned in the description of the existing Q&A, which is live on our YouTube channel. So you can just go and join the community and you will be getting all the updates over there regarding when is the live uh, and all sorts of feedback forms and everything. So yeah, so that's it, sir. We actually got three questions and it's time. So let's wrap it up for today and we'll meet in the next episode of Decoding Market in Three Moves. Till then, trade safe, trade smart, use strike. That's it. Thank you everyone for joining. Thank you, sir. Thank you.
Thank you. Thank you.